I'm very glad I can present this paper here because this is on a topic which is actually relatively understudied and mostly because of data issue. In the Netherlands at least, this has been funded with research money from NetSpar, and when I wanted to include this paper on my grant, which was about retirement, people at NetSpar were saying like, are you sure this topic is like connected to retirement at all? I think now after a couple of years doing this research, it has become very evident that this is a very important topic. Is the elderly going to repay their debt? And what will be the cost, the future cost of indebtedness if they don't? I have to say a couple of things, of course, here, because in the Netherlands we have had a lot of financial innovation, as in many other countries, and I will focus explicitly on the mortgage debt, which is the largest part of debt in the Netherlands. And financial innovation has implied that we do not amortize our loans basically anymore, at least for a large part. However, the tax system is also favoring indebtedness because we have a mortgage interest deduction, which is extremely generous. However, this will expire 30 years after origination of debt. And if you still have debt, you can no longer have that. Not only, the system has been changed. As of 2013, you must amortize your mortgage. So when you retire, you will experience a lot of things at the same time, which are pretty negative. One will be an income drop. The other one is that if you have to prolong your debt, you no longer have the mortgage interest deduction. You no longer have the interest-only loan. And maybe you even get a higher interest rate because now the interest rate is historically very low. But in the future, it might not be. So if all those things happen at the same time, it could be that the elderly is in trouble. We couldn't answer those questions before because we didn't have the data. And I have put this slide first, even before showing the facts and figures, because that's the one thing I'm the most proud of. I'm now working, oh, sorry, I didn't say my name. My name is Mauro Mastrogiacomo, but it was on the slide. I work at the Dutch Central Bank and at the Vrije University. And thanks to my affiliation to the Dutch Central Bank, we managed to convince the banks to give us the data on all their customers. So they deliver to us at loan level all the mortgages that they have issued to their customers. There is about 3.7 million borrowers in the Netherlands that bought their house with a mortgage. And for 3 of them, we get data every 3 months, which is about 6 million records. So it's a very, very big data set. We started in 2012, and we did that because we decided not to believe the banks anymore when we do supervisions about the healthy status of their customers. We decided to check that ourselves. But those data appear to be very, very good also for research purposes. We asked about 150 mortgage characteristics, and half of them are kind of reliable, and the other half not so much. We survey 12 banks, going to become 13 next year, and we cover about 80% of all existing loans in the Netherlands. However, for the moment, this is voluntary reporting, so I have to ask you to please not circulate this graph yet, but as of 2017, we become also the owners of the data. So we can do a lot more. We can even share them for research. So this is a nice opportunity also for people to do more with us. And we are also going to link those data to the tax record data, which is something we couldn't do as yet. So what are the questions I want to answer? The motivation of this research is that we have a lot of interest only that. I will show the figures in a minute. Also for the part of amortizing debt, we don't know exactly how much people amortize because of fiscal reasons, we have this type of mortgages. We call them like savings or life insurance mortgages, in which you do not actually amortize. You are saving money in a pledged account, but that's invisible. to the tax office. So you don't pay taxes on it, which is good. The bad part is that, therefore, it becomes also invisible to researchers. So we never actually know how much people are putting aside. Then we also have annuity and linear mortgages, like you have everywhere, but those are a really small group. And also we have even more exotic products, like the investment mortgages. Those build up those invisible accounts, but there is no deterministic way to build up, because you just put the money on stocks, and if the stocks have a good return, you're lucky, but if they don't, you become pretty unlucky. And to make it even worse, those products in the Netherlands, they must be a sort of insurance type of product to be fiscally facilitated. And in order to do that, you have to pay a premium. So if those investment loans do not deliver the expected result, the amount that you have to insure grows over time, because you're not reaching your target. So your premiums are going up. So that makes it even more difficult to achieve full repayment in those products. So we would like to know how those products are developing, how they will look like around the period of your retirement, and if you don't manage to repay, who are the ones who are not repay. And in addition to that, even a more ambitious question is, in the Netherlands, because of the tax system, it is favorable to have very high debt on the one side because of the mortgage interest deduction, but accumulate assets on the other side. And the things can coexist at the same time. I suppose to some international audience this might look very irrational, but tax can be very distortive of behavior sometimes. So we also would like to know, maybe they have put money somewhere in the bank account, for instance, and they could use the money to repay the mortgage, so maybe there is no problem. But I will show that actually there is a problem even there. So let's start with the facts. On the left-hand side, you see actually this is twice the same picture, but looked at it from different perspective. On the blue side, you see the composition of outstanding debt by loan type. So every individual can have multiple loans. I have 6 loans for my house, for reasons I'm not going to bore you about, but people can have very different ones. And you see that annuity and linear mortgages represent together about 4% of all the outstanding loans in 2013, when the system was changed. Then you have a certain amount of saving and life insurance, the ones that deterministically put aside the money even though they do not amortize, and this is 19 and 10%. Then you have 7% of investment loans with uncertain type of repayment. Maybe you're lucky and you repay in full, maybe not. And then you have about 60%, 58% is interest only. So people basically, they get the money, they pay only the interest. Say you borrow 100,000. After 30 years, the 100,000 is still there unless you voluntarily repay it periodically, but there is no obligation to do so. And we will see that indeed the voluntary repayment stays behind. On the pink side, we look at it from the borrower level. As I told you, one person can have multiple loans, so it could be that you have half of your loan is in interest only and the other half is in a saving, or maybe it's all of it, it's interest only. So here I try to plot that. And for instance, you see that the people who are fully repaying their mortgages, only 19%. And by fully, I mean linear, annuity, saving, life insurance, 100%. But you see that the opposite, 32%, is completely interest only. So they have no other form of repayment. And then there is about half is a combination of either interest only or repayment. However, when you do have an interest only, as I said, you can voluntarily repay yourself. And actually, the government has tried to facilitate that when a lot of mortgages appear to be underwater because of the financial crisis and the drop in asset prices. Thanks to the loan level data, we can finally also understand, this is a macro level picture, so this is the aggregation at country level for the amount of billions that have been voluntarily repaid in the period 2013 first quarter to the first quarter of 2016. And what you see here, I have differentiated 3 periods. In the first period, we had the usual policy. You can receive money from your parents to make repayments, for instance. Then in the second period, in the middle, between 2013 Q4 and 2014 Q4, the government facilitated parents and actually even your friends to give you money up to 100,000 tax-free. So it's a sort of way to avoid inheritance taxes. And you see that the voluntary repayment started increasing. And then also at the end, more recently, after the enormous drop of the interest rate, it became very profitable to redeem your mortgage, so that has stayed at a very high level. This is the macro picture. From a micro point of view, the definition is a little more complex because we have to look at shifts over time, and we have censored, so we can compute the difference over time in your debt. That's not a very precise definition. Sometimes you get very, very small numbers. And however, a voluntary repayment must be at least of 2,000 euro. Otherwise, the bank will not do all the administration work for you if you repay less. And you see there are some spikes at the usual suspects, like the institutional, like the 50,000 over there at the 100,000, but that's smaller. Those are the legislated maximum amounts to be received as a present. However, most are very low numbers, below the 20,000 euro get repaid each period. So what we aim to do here is to make a projection. We know all the characteristics of all your loans that are needed to compute the future indebtedness when it comes to the amortizing part. That's easy. We are here assuming that people are not going to change anything to their mortgage loan, and actually this is a conservative assumption because typically people would, make a career like going from a small apartment to a larger one and thus taking more debt. The opposite, downsizing, is a lot less observed in the Netherlands. Actually, we observe that elderly people tend to be very housing rich and do not like to go, for instance, to a retirement home or something like that. So in a sense, I'm being conservative in making this assumption. So the deterministic part is easy, both for the annuities and linears, as well as for the saving and life insurance. The more complicated part is the voluntary repayments. We have observed 15 times individuals doing voluntary repayments, so we will try to extrapolate on that by using a two-steps model. The methodology, I will try to explain it simply. So the dependent variable is here the voluntary repayments, and this variable is 0 with positive probability, but as a continuous and random positive value. So the way to deal with it would be to use corner solution response model. So that's what we're going to try to do. What we're going to do is try different specifications and compare them. The problem here is that we have truncated the distribution to 2,000, so we have to correct for that. And I will try to be very brief on the technicalities because I have understood that not the entire audience is academic. In this slide, basically, I explain how to deal with the fact that we have this non-zero censoring at the level of 2,000, which is L, so we have to make correction for that. And then here I explain how to make comparisons of the marginal effects that I am going to show in the table of the results. So let me not waste time on those technicalities and go further with the type of results we're going to show, because this is pretty simple. So I show here 3 sets of results, at least in the paper. In the presentation, I will only show actually one to make it even simpler. The first has to do with the probability whether you will make a voluntary repayment or not. The second is that if a voluntary repayment is made, how much do you voluntarily repay? And then we want to add also the amount of money saved, which is not present in the data. So we estimate in another data set a saving equation. And due to common characteristics in the both data sets, we try to get an impression on how much people might have saved at the time of their retirement. So this is the standard unfriendly table, so that's why I only show one, that appears in all presentations. This is here only to show you how little right-hand side variables we have, because I told you I have a lot of mortgage characteristics, but very few borrower characteristics. This is something that we cannot help us as long as we don't merge the data with the national statistics data. So what we correct for here, so this is a table on the probability of you making a voluntary payment or not. Here I correct for age, and you see that when you become older, you are less likely to make a voluntary repayment. That could feel like normal because these people have already been maybe repaying contractually for a long time, so there is less need to do that. What is interesting here is that the share of interest only, the IO share, has a positive effect. So people that have a higher share, like the ones 100% would be the highest, they do repay voluntarily more often. So for each 1% additional share, you are 4% more likely to repay, which is a strong effect. The interest rate has a negative effect, and that captures the idea of arbitrage. When you get very low return on your deposits, then the difference between your return on deposits and what you pay on your mortgage shrinks. Then I have a dummy for whether you're underwater. NHG is the Dutch insurance for mortgages. You see that the ones who are insured are also less likely to repay. Maybe some type of moral hazard idea could be behind it. LTV ratio is the last characteristic, loan-to-value ratios. So I have very little right-hand side characteristics. And not only, I don't even have an exclusion restriction. So in the end, we do a two-part model. So I have exactly the same variables if I had now to put the amount of the voluntary repayment, how much it is, which is a pity, of course. What do we do with those estimates? But as you see, of course, I have almost 2 million people in here, which again is a qualifying part. So this is a chart that explains how the simulation works. We start in 2013 when the new mortgage rules have been introduced, and the grandfather debt in the Netherlands was looking the worst, historically speaking, in terms of repayment. So the first step is that we estimate the voluntary repayment in T+1 using those type of models. Then we update the observation by reducing the debt, for instance, increasing or decreasing the value of the house depending on a scenario that we implement, making people age of 1 year each year, and so forth. With those new updated estimates, we estimated the saving equation that we had borrowed from the other data from national statistics, and we do that iteratively for 30 years. And when we reach the last year, we end the simulation. What are the results that you can produce in such a framework? Well, you can only, of course, produce scenario type of results. So let's look first at the micro level. On the vertical axis here, you have the loan-to-value ratio. And on the horizontal axis, you have the year. And year H means house prices development. And I have scenarios here with 0%, 3%, and -2. V is whether you do a voluntary repayment or not. And you see that in the worst case scenario, if house prices were to drop by 2% every year, and there is no voluntary repayment, the loan-to-value ratio stays almost constant. And that's why we generated this scenario. And it does not increase because of the contractual repayments, of course. However, in the most favorable scenario, the one in which house prices, with the housing market looking a bit German, 3% every year, and people behaving properly, voluntary repayments and so forth, then you see that the loan-to-value will drop significantly to below 20%. So this very much depends on the type of scenario you assume in terms of the development in house prices. Either cases, those customers don't seem to be a problem for the banking sector. If they were not to repay their mortgage, their LTV is below 1, so there shouldn't be large losses, shouldn't be made, even with the little amortization that we do in the Netherlands. However, when it comes to the macro story, there the value of the house is a lot less important because that is nominal. We had a little above 600 billion euro in debt when we started the simulation. And if we only account for for contractual repayments, the black line, only 1/3 of this will be repaid after 30 years, which is very little. If we add voluntary repayments, the three colored dashed lines, it's another 1/3 that goes off, so we get to 200. And those lines are different only because I've used different house prices, the behavioral idea that when people feel richer, they might be repaying less. And the last line is the one in which I add mortality. I make the mechanic assumption that when the youngest spouse becomes 85, that will be redeemed, for instance, because the children sell the house and repay back the bank. So if you have an idea that the mortgage is a product that after 30 years has a life cycle and this terminates, this does not emerge from the data. The interesting finding, however, is more at the micro level. Here I plot the residual debt and the savings that have been estimated using the model. In the upper figure, we look at all the sample, and you see that around maturity year 2037, there is a peak in the residual debt of about 90,000 euro against a personal wealth of about 30,000. This is not shocking. If people used all their money to repay the debt, they only have 60,000 that they have to solve. You can downsize, you can maybe get an additional loan. It doesn't look horrible. However, when you look at some specific groups, for instance, here I have put the self-employed. Those people, observationally speaking, they have bought more expensive housing using more debt. They will have about 150,000 residual at the peak of the problem, but not much larger financial assets. So for those people, the problem might be appearing. In addition to that, as I told you, most people will be almost retired by the moment in which they reach maturity. So when they reach that peak, you see the black line is the amount of self-employed that have reached ages in between, let's say, 65 and 70. Half of them will be at around the age of retirement when their mortgage matures. And at that time, they will have very high outstanding debt. The white bars are for the self-employed. At that age, about 150,000. So here what we did was to make a simple back-of-the-envelope computation and say, okay, say that after 30 years, the bank knocks at your door. Now you have reached one of those ages, and that's the amount of debt that you are left with. And they tell you, let's look now at the interest rate. Let's assume it's 3%. You no longer have mortgage interest deduction. And I'm not asking you to use your savings. I will give you a new loan. But now the problem arises if I don't give you an interest-only loan anymore, but I give you an annuity, we have to discuss how long it will take for you to repay now, because you have already had a mortgage for 30 years. Let's say now I offer you either an interest-only or an annuity for 10 years. That seems pretty okay as proposal, right? Because then you have been having the debt for 40 years, and it could be reasonable for the bank to demand that. Well, in that case, cost can vary a lot. So for the self-employed, you could go from like 500 euro in the case of the interest only to 1,500, 2,000 about if they offer you the annuity to be repaid in 10 years. So the future well-being of this cohort of self-employed might be severely affected by the cost of indebtedness. For the non-self-employed people who have lower debt, this is a lot less so. However, in those computations, we have assumed that all the debt in investment loans will not be repaid, and that is too harsh of an assumption. So let me relax this, but partially, and I show only this last table. We asked ourselves, and the data allow us to check this, say that you have an interest-only loan, but you have multiple loans, maybe. How much of the residual debt is being amortized? So say, for instance, let's look at the first column, that 20% of your entire debt is interest in investment loans. Where is the other 80%? Well, in 73% of the cases, it's in interest only. The same happens in the second column, 40% investment, whereas the rest, in 85% of the cases, 60% is interest only. So it means that the most popular combination for investment loans is to be combined with interest only. So there is basically no contractual repayment being made. So this means that also the owners of investment loans are amortizing very little. And I had a graph here to show you how little they are building up. And just for you to have an idea, let me only talk about the areas in this graph. There is the big peak of the mountain, that is the debt that you should be repaying at maturity. And the little hills, the one below there, it's how much you will be able to repay with what you have accumulated in those investment accounts under the assumption of a future return of 2% or 4% yearly. So let me conclude. So part of the current debt in the Netherlands has already been repaid, actually. We didn't see it in the data before because we didn't have the data available. But there is some voluntary repayment, and there is also the pledged accounts. However, the assets that people accumulate, for instance, in their savings account, will not be enough to repay the rest. This could be should be no problem for banks, but could be a problem for some specific groups. And the only problem that we might envisage for banks at most is that the deposit funding gap could further enlarge because money needs to come from somewhere. Banks don't directly print it, so they have to borrow it from the money market. The groups that we identify are the self-employed and the owners of investment loans, are being the ones more in danger to have very high future costs of indebtedness. Thank you.